Investing has become one of the most essential skills in today's financial world, especially as we move deeper into 2026, where economic landscapes, technology, and global markets continue to evolve rapidly. For beginners, investing can feel overwhelming, filled with complex terms, risks, and countless options. However, the truth is that investing is not reserved for experts or wealthy individuals. It is accessible to anyone willing to learn and take a disciplined approach. The goal of investing is simple: to grow your money over time so that it works for you instead of you working only for money. With inflation rising and the cost of living increasing, relying solely on savings is no longer enough. Understanding how to invest wisely is key to building long-term wealth, financial independence, and security. Today, we will talk about Beginner's Guide to Investing in 2026. So before we start, make sure to hit the like button and subscribe to my channel. What is investing and why it matters? In 2026, investing is the process of allocating money into assets with the expectation of generating profit over time. Unlike saving, which focuses on preserving money, investing aims to grow it. In 2026, investing is more important than ever due to inflation, technological innovation, and changing job markets. When you invest, your money has the potential to earn returns through appreciation, increase in value, dividends, or interest. Over time, these returns can compound, meaning you earn returns on both your initial investment and the profits it generates. This compounding effect is one of the most powerful tools for building wealth, especially when you start early and remain consistent. Understanding the different types of investments. There are several types of investments available, and understanding them is crucial for beginners. Stocks represent ownership in a company, and their value can rise or fall depending on the company's performance and market conditions. Bonds are loans you give to governments or corporations in exchange for regular interest payments. Mutual funds and exchange-traded funds, ETFs, allow you to invest in a collection of assets, providing diversification and reducing risk. Real estate involves investing in property to generate rental income or capital appreciation. Additionally, newer investment options such as digital assets and technology-driven platforms have become more popular in recent years. Although they often come with higher risks, the importance of setting financial goals. Before you start investing, it is important to define your financial goals. Ask yourself why you want to invest. Are you saving for retirement, building wealth, buying a home, or funding education? Clear goals help you determine how much risk you can take and how long you can invest your money. For example, long-term goals allow for more aggressive investments, while short-term goals require safer options. Having a clear purpose ensures that your investment decisions are aligned with your overall financial plan. Risk versus reward, finding the right balance. Every investment comes with a certain level of risk. Generally, higher potential returns are associated with higher risks. Now, understanding your risk tolerance, how much risk you are comfortable taking, is essential. Beginners often make the mistake of either being too cautious or too aggressive. A balanced approach is usually the best starting point. Diversifying your investments across different asset classes can help manage risk while still providing growth opportunities. The key is not to avoid risk entirely, but to manage it wisely. The power of compounding is often referred to as the eighth wonder of the world because of its ability to grow wealth exponentially over time. When you reinvest your earnings, your investment grows at an increasing rate. For example, if you invest regularly and allow your returns to compound, even small amounts can grow into significant sums over the years. The earlier you start, the more time your money has to grow. This is why starting early, even with small amounts, is one of the most important principles of investing. Building a diversified portfolio. Diversification is a strategy that involves spreading your investments across different assets to reduce risk. Instead of putting all your money into one stock or asset, you invest in a mix of stocks, bonds, funds, and other options. A diversified portfolio helps protect you from significant losses if one investment performs poorly. In 2026, diversification also includes considering global markets, different industries, and emerging technologies. This approach ensures that your portfolio remains balanced and resilient in changing market conditions. Choosing the right investment platform. With advancements in technology, and investing has become more accessible than ever. There are numerous online platforms and mobile apps that allow beginners to start investing with minimal capital. When choosing a platform, consider factors such as fees, ease of use, available investment options, and security. Some platforms offer educational resources and tools that can help beginners make informed decisions. Selecting the right platform is an important step in building a successful investment journey. Common mistakes beginners should avoid. Many beginners make mistakes that can hinder their progress. One common mistake is trying to time the market, buying and selling based on short-term trends. This approach is risky and often leads to losses. Another mistake is investing without proper research or following trends blindly. Emotional decision-making, such as panic selling during market downturns, can also negatively impact your investments. It is important to stay disciplined, focus on long-term goals, and avoid reacting to short-term market fluctuations. The role of consistency and discipline. Successful investing is not about making quick profits. It is about consistency and discipline. Regularly investing a fixed amount, regardless of market conditions, is a strategy known as dollar cost averaging. This approach reduces the impact of market volatility and ensures that you are continuously building your portfolio. Discipline also involves sticking to your plan, avoiding unnecessary risks, and maintaining a long-term perspective. Understanding market trends in 2026. In 2026, several trends are shaping the investment landscape. Technology continues to play a major role, with sectors like artificial intelligence, renewable energy, and digital finance gaining attention. Global markets are also becoming more interconnected, offering both opportunities and challenges. While it is important to stay informed about trends, beginners should avoid chasing hype. Instead, focus on fundamental principles and long-term strategies. Trends can provide opportunities, but they should not replace sound investment decisions, building financial confidence over time. Investing can feel intimidating at first, but confidence grows with experience and knowledge. Start small, learn continuously, and gradually expand your investments. Reading books, following reliable financial resources, and learning from experienced investors can help you build a strong foundation. Over time, you will develop the skills and confidence needed to make informed decisions and navigate the market effectively. Start small, think big. Investing in 2026 offers incredible opportunities for those who are willing to learn and take action. While the journey may seem complex at first, the basic principles remain simple. Start early, stay consistent, diversify your investments, and focus on long-term growth. You do not need to be an expert to begin investing. What matters most is taking the first step and building good habits along the way. With patience, discipline, and the right mindset, you can turn investing into a powerful tool for achieving your financial goals and securing your future. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.